Still good morning, just about. Welcome everybody, and congratulations for braving weather to hear a lot of robust and interesting analysis on the state of the currency market right now, which I did a little bit of reading on the way. I thought it was exceptionally clever of Gail to get a moderator so clueless at the intricacies of the foreign exchange market, so I can ask the questions that are most important. But I think the best way to get started is we're going to ask you a couple of questions later just to get a feel for where you are in terms of your sentiment and how you're weighing things up. But to begin with, I'd like to invite Martin to step up, maybe introduce yourself and take us through a couple of quick observations, and then we'll hand on to Tim.
Good morning, everyone. My name is Maarten Spek. I'm a senior analyst of ECR Research based in the Netherlands. I think I'm one of the only continental research provider here among this on this day. I've prepared some slides, and I think I've joined the previous two sessions of global macro and the asset allocation. They also talked quite a lot about currencies, and what was striking it was the near consensus that the dollar would depreciate further this year, and we think that the dollar will surprise, that will appreciate this year, and for that I have some slides. Let me see where they are.
Hit the down button.
So maybe the biggest conundrum in the FX market today is if you saw last year there was in 2016 there was a very close correlation between the differential between the 2-year interest rates between Germany and the US and euro dollar. However, last year that relationship broke, and there was a quite significant divergence between those two. And in the last couple of weeks or 2 months, there were a lot of stories about why is that divergence going on. The main reason cited for this divergence is that, look at the prospect or the outlook for the government deficit in the US. Look at the deficit on the current account of the US. Those two twin deficits are hard to finance. People are losing faith or trust in the dollar. So if they want to wish to invest in the US, in US bonds, for example, which is the biggest capital flow, then they need to hedge their currency exposure. And if you take the two, and if you take the interest rate differentials as a proxy for hedging costs, then it's very expensive to hedge. So it's not, and in on a hedged basis, it's even more attractive to invest in European bonds despite their low yields. But that's a kind of reasoning which automatically leads to expectations for a lower dollar, because to finance the twin deficits without enough capital inflow, either the dollar has to weaken further or interest rates have to rise even more. However, if interest rates in the US rise even more, then it becomes even more expensive to hedge your currency exposure. So that makes it even less attractive to invest in US bonds. So that's a kind of kind of reasoning which always lead to a lower dollar. But there are a few factors which argues to the opposite side. And the first one, you can also argue that it's very expensive to speculate for an even further depreciation of the dollar. so it becomes more attractive to speculate on a stronger euro instead of a weaker dollar. If you look at the difference between the changes in the balance sheet of the Fed and the ECB, you see a clear correlation between those two. In the last couple of quarters, the relative difference between those balance sheets were declining, and because of tapering by the ECB, or a reduction in QE by the ECB, and not any change in the balance sheet of the Fed. However, the ECB will continue its QE policy until September. After that, many speculate that the ECB will taper until the end of this year. However, if you look at the current inflation measures in the EMU, they are surprising to the downside. So the ECB won't probably in a rush to taper its QE policy after September. However, we now know that the Fed will be a net seller of treasuries. So their balance sheet will decline even further, and the ECB's balance sheet will not grow faster, but it won't decline a lot either. So the relative changes of the balance sheet of the Fed and the ECB will stabilize or will even go a bit up, which has a negative effect on euro dollar. The second one is it's really surprising why the US trade balance is declining so much. Because if you look at oil production, it's very high. And the US will become the biggest oil producer in the world this year, probably. And if you look at the dollar, it's a huge stimulus for US exports. And of course, we all know that, I think from economics, you have the J-curve effect, that once your currency depreciates, in first instance, your imports are going up, but in second instance, your exports are profiting more from your weaker currency. And we think in the coming months, that second instance, that your exports are profiting from the weaker currency will be shown. So we think that the latest decline in trade balance is a bit not overblown, but we think we will hit the bottom quite soon, and that the trade balance will improve. On the other hand, in Europe, we think the trade balance will deteriorate slightly because of the stronger euro, and also because the EMU will consume and invest more, we think, so they have to import more. So those are three quite strong reasons why the euro dollar will, we think, decline. And there's another one, and that's more structural, more fundamental. That's the US dollar is the world reserve currency, we all know that. And there's a debate whether the Chinese yuan will change that position. However, for world currency, or to be a reserve currency, you need, or it's very helpful if you have a trade deficit. Because the world needs dollars, and one of the few ways to supply the dollars to the world is via a trade deficit. However, if you look at the role of the U.S. economy in the world economy, it's declining. But if you look at the role of the U.S. dollar, it's also declining, but less so than compared to the role of the U.S. economy in the world economy. So, in other words, the world is still dollar-based, needs more dollars relative than the U.S. economy, the declining share of the U.S. economy in the world economy could supply. So the shortage of dollars, we think, is building up. And once the trade balance will improve, once interest rates will rise further, once investors will start to acknowledge that the prospects for the dollar are improving, and the cost of speculating against an even weaker currency are mounting, we think that will change the perception for the dollar for a further depreciation into an appreciating the outlook for a more expensive dollar. So that's why we think that the negative view for the outlook for the dollar is overblown. That a lot, if not everything, negative for the dollar is already priced in, and that the near future is one of a dollar resurgence. That's for it. That's it for now.
Thank you very much, Martin. Tim, maybe you could give us your perspective on all of this, and then we'll open up.
Good morning, everybody. My name is Tim Parker. Our firm is called Messels. And the reason it's called Messels is that my great-grandfather was called Ludwig Messel, and he came over from Germany in 1873 to set up a firm of stockbrokers in London called L. Messel & Co., which went on until 2008. Well, actually, it was taken over by Shearson Lehman in 1986, and Shearson Lehman Lehman Brothers went the way of the world in 2008. So we took the name back and thought, why not? And we've been doing our research for about 25 years. And our approach is technical, so it's not complicated in terms of the way we do it. It's very straightforward, deliberately so. We've heard this morning quite a lot of a range of views, a lot of talking heads on the macro and the global asset allocation, and very few definitive answers. Except I think there was one definitive answer that came across this morning, which was when everybody stuck up their hands to say that US T-bond yields are going up. That was a consensus, if you ask me. There was an incredible expectation that yields are going up from here, and they will get through 3% in no time at all. Well, I wonder from a technical point of view, but we're not going to talk about bonds here. We're talking about currencies. Martin very aptly talked about potential dollar strength, and I think this is a non-consensus call again, and our view is very similar. What I'm going to do is I'm going to run through about 20 charts, no more than that, and very, very simple long-term charts, so data points are a month apart or a week apart over the long term to try and get a perspective of where actually price action has been taking us, and under the theory of serial correlation, what might happen in the short to medium term future. So if we start off with the dollar index, I hope you can see that. This is a dollar index going all the way back to 1988. Every bar on there is a monthly bar. And very straightforward technical analysis where we're drawing trend lines. And you could argue that you should argue that the technical analysis is objective. The peaks are the peaks, the troughs are the troughs, and if you join up the lows, you'll get a trend line. Join up the highs, you get a downtrend. That sort of thing. It's very objective. It's Dow theory. Charles Dow started this stuff back in the 1890s. So it was at the same time as Ludwig came over from Germany, and it's still going. And the whole point about it is that whatever the ebb and flow of the economic and policy or political arguments, geopolitics, whatever it may be, at the end of the day, capital flows are enacted by investors and traders around the world. And in such a complex market, much better to get an idea of sentiment and confidence from the relative charts of crosses and seeing actually where the prices are than trying to be too clever with, we're simply not clever enough. I guess that's it, really. Okay, so the dollar index here, you can see very straightforwardly joining the highs there. There is a range that we broke out of back in 2015, broke out to the upside, and now we've come all the way back to a double support So that support dates back to 2008, 2009, the peaks there. There's also an uptrend level. That's quite strong support for the dollar index, long-term chart. So this is not 5-minute stuff. This chart was done on the 23rd of February, and it has already reacted. So that's the basket. And then if you look at the crosses elsewhere, that's the euro dollar. Again, the euro, there's a consensus. I say there's a consensus. Many people would think the euro is going to strengthen, and the arguments put forward this morning were quite persuasive about why the euro should strengthen. And this is against the dollar. And we've got an 8-year downtrend line, and we've come up to it, and we've reacted there already. And this is a monthly chart, candlestick chart. So it's not going to be a straight line thing. We've already become slightly overbought on the way to that downtrend, and now we've hit the downtrend. And actually, the euro is not going. It's not going to be easy trading going straight up to 140 or anything like that. So again, the euro question mark over euro strength. This is more about dollar strength than euro strength. This is the dollar against the renminbi or the Chinese yuan. And again, that's a long-term chart back to 2014. We come all the way back. That's dollar weakness in red on the right-hand side. Come all the way back to that. Again, double support, and we've reacted at around 6.3 or 6.28. And again, so the dollar has done the damage. It's had the weakness. A lot of this stuff is discounted in the cross. So there again, the dollar might actually find a bit of strength against renminbi. That's the dollar Swissy, bottom of the range, or towards the bottom of the range. Not a huge amount to tell from that, but it's been range trading since 2012. You see the spike down in 2015. That caused a bit of consternation among the traders, but we got back into the range where we've stuck in that range again, and we're towards the bottom of it. So again, that implies that the dollar might actually just begin to rally again from the to the bottom of the range. But that's where we are, and that's a weekly chart, so a bit more short term. That's against Canadian dollar. Again, back till 2012 or 2013. Monthly chart, monthly candlesticks, we got to the uptrend and we've reacted there. So the dollar is beginning to make some progress against a resource currency, and that's quite interesting. And that's another resource currency, the Aussie dollar. So the US dollar against the Aussie dollar has pulled back to the bottom of the range. It is supported. That's right, that low back goes all the way back to 2003, a monthly chart. Again, the dollar is supported. So it may well break down. I'm not trying to say that it will or it won't. But at this end of the range, would you want to bet against it with that support and reaction there at this stage? It's more of a 50-50, or actually I would say it's 55% in favor of the dollar. This is the one that's the interesting one at the moment, because this is a contrary argument. This is Japanese yen strength, and that's dollar weakness. And the yen is definitely strengthening. We've broken that uptrend on the monthly chart. Uptrend since 2012, 2013, which means that the dollar is on its way down against the yen, but actually maybe this is more about yen strength than dollar weakness. And that's the countervailing argument. So the yen, as something of a safe haven, is in the fray and has broken out against the dollar. But net, it's about that dollar index rallying from here in our view, and that's sterling, that's cable. So again, support dating back to 2000 or so. We've rattled all the way up to it. We've reacted at that. It's a monthly chart, and begun to pull back. So again, you can see the Brexit pullback in 2016. We've rallied from 120 all the way up to the 136, 140 level really, and have begun to pull back again. So again, top of the range for cable, and the longer term downtrend you can see also in place there. So again, sterling looks a bit troubled, and this is what I'm going to go onto in a sec, just on the euro and sterling. So this is about dollar strengths. So moving on to sterling. So you saw it against the cable hitting some resistance there. This is cable. This is sterling against the Japanese yen. Also top of the range, has reacted. Long term chart. Sterling's going to struggle. Sterling against the yuan or the renminbi, longer term downtrend, the down channel, that remains in place, and looks like drifting lower in terms of sterling terms against the renminbi, and that continues. Sterling against the Swissy, less definitive here because we're mid-range on a 2-year view, but look at that longer term chart. So you had the big drawdown, some ranging, an attempt at a base formation, and then that broke down, and we're attempting to base formation again, but it looks quite troubled, and that's all about Swissy strength over sterling, and that's sterling against the Aussie dollar, again, top of the range at 180, and has begun to pull back. So again, dollar strength, sterling weakness, and that's sterling against the Hong Kong dollar, also reaching resistance and begun to react. So the picture's beginning to build up. I hope you'll see that. Dollar strength, sterling weakness, and then, that's against the Argentinian peso. I thought you'd like to see that. That's a bit of sterling strength, slightly ad hoc. And then moving on to the euro, just briefly, we'll finish off with this. The euro hitting downtrend resistance against the yen. That's about yen strength, as I said. But again, a big level dating back to 2008. Big downtrend. We have reacted. Bottom of the range is 110, 112. So that looks slightly troubled. Euro against sterling. Interestingly enough, this is not trending particularly well. It has been in a range, and this is actually euro against the pound rather than pound against the euro, if you see what I mean. But again, resistance at the top of the range, and that's about the euro might struggle a little bit against sterling. Euro, Aussie dollar towards the top of the range. Euro against the renminbi broke out, yes, of the downtrend, but now failing to get through that 8 level. Again, big resistance. I put an MACD in there. Apologies for that. That's a bit complex. A moving average convergence divergence signal, which we try not to get too involved in too many of the too many derivatives away from price action. We don't like to do that too much. This is the euro again. That's all about Turkish lira weakness, but that's just put for fun. Canadian dollar, so just a couple of currencies here that are just range trading. So Canadian dollar, Swissy just going sideways. Canadian dollar, Norwegian krona. Again, these are hard currencies that they just range trade. Every now and again they break out to a new range, but most of the time they're range trading. This is the South African rand, which actually it's Aussie dollar against the rand. That's rand strength that's come through on the political change there. And getting down towards support. So that's Aussie dollar weakness against the rand, and sterling against the rand there, getting to support. I'm not going to dwell on that. And finally, Bitcoin. Dare I mention it? Shall I say it? But anyway, this is a chart of Bitcoin for those of you who are interested. Weekly candle stick. Obviously, we had the huge ramp up. We broke out, and we came back to that double level of support at $6,000. And we bounced precisely off that. We rallied from it, but momentum has rolled over. And that's Bitcoin Cash, final chart, on a daily picture, top of the range and beginning to pull back. So, I mean, whatever the cryptocurrencies are, whatever they may be, the easy money is made. Now it's a case of will some decent analysis emerge on cryptocurrencies. And certainly from a charting point of view, there's a reasonable amount of liquidity now, so we can get some idea of trend and inflection points and trend breaks. Thank you very much. That's just a quick roundup from me. There we are.
Very good. Well, thank you, gentlemen. We'll dive into some of these issues in greater detail from both perspectives. But I thought to begin with, maybe we could just frame how clients in practice would use some of this work at this part of the cycle, and kind of what your toolkit is at the moment. So, I think, looking at your charts, obviously I can see a lot of applications and a lot of possible implications on people's portfolios. But looking at the market where we are, how does a client in practice use this, and how should they use it? Obviously it depends who they are. But I'm thinking about time horizons. I'm thinking in isolation or with other styles of work. Is it an early indicator for then the macro to confirm, and then do you move on? So maybe just give us a little frame of the toolkit and how you use it and how your clients use it.
Well, the whole point about chart, I don't want to teach you to suck eggs. I'm sure you all know this, but the whole point is that it's cutting through the noise. There's an awful lot of whatever part of the cycle we're in, there's an awful lot of noise surrounding assets, asset classes, instruments of various sorts. And all technical analysis does is to cut through that. And the way that you use it most effectively is to try and excuse your emotion and take your emotion away from it. because a lot of this is behavioral, and investors as a group, as you know, tend to behave in a herd or a crowd. And it's often very easy to get swept up in that. But if you can actually step back and say, well, actually, what is the price doing? Maybe the relative chart too, but basically the price. And which way is it going? And you can argue that the shorter term can be allied to the medium term, can be allied to the long term. So when you're looking at those are all long-term charts. Yeah. But if you're your trading might be on a daily basis or an intraday basis, or it might be on a weekly or monthly or whatever the basis is. When you get the confluence of signals across time frames, that's really useful.
Across technical work.
Sorry, this is technical work. And simplicity is all. I mean, I know next to nothing about the economics, politics, and everything else involved in currencies. And probably the less I know, the better, because all that does is influence my judgment. And technical analysis is not about completely about objectivity. There is a subjectivity involved, which is where do you draw the lines? Where do you draw the lines? What is your confidence factor when these lines are tested? What does your experience tell you happens in these instruments when they get to these sort of levels? And that's where the subjectivity comes in. So technical analysts, they do differ. Some are good, some are not so good. And usually the good ones are the psychotic ones. They're the ones who are completely glued to their screens and don't take much notice of the noise or the flow of emotion.
And is the art in the conviction level of the support dependability that you're communicating to support levels?
So it's a combination of the grunt work of trawling through charts and trying to find the levels, but equally it's about the eyeballs of the individual who's doing the charting. My colleague Dominic is psychotic, and he's really, really good at this, and he's better than I am. Because he's just so disciplined, and it is all about discipline.
Interesting. We've got a question over here.
Just wanted to ask a question, because in the last panel we saw people saying that the Bank of Japan was targeting the yen level as its policy gauge. The question is, what can the Bank of Japan do, and could they actually influence some of these charts that you're talking about in terms of the yen, or are these trends so heavily supported by huge amounts of money that the Bank of Japan can't do anything against them?
Martin, maybe you can do.
I think the Bank of Japan wants to influence its currency. However, they are very unsuccessful doing that. All they are doing now is following a monetary policy to weaken the yen. And if you look at the charts, the yen is not weakening, it's strengthening. And the main reason for that is that their net investment position worldwide is very positive. So as soon as Japanese investors distrust the dollar or distrust the economic climate or have a more negative outlook for economic growth or return expectations outside Japan, they tend to sell their assets, their foreign assets, and return their money home. And that has a strengthening effect on the yen, and that's irrespective of what the monetary policy of the Bank of Japan is.
And so you're aligning with this safe haven theme for this year on the yen?
Yeah, we do.
Very interesting. Just maybe for a second before we widen out, maybe just take a quick straw poll. What time range should we do for dollar, bullish or bearish?
We think that in the coming quarters, so until the end of this year, approximately, the dollar will strengthen, and after that we forecast a severe bear market.
Okay, so let's do both then. So let's do, so end of this year, if you are dollar bullish, put your hand up. If you are dollar bearish, put your hand up. Comments, anyone?
Yeah, no, I just think all the bears should leave the room, that's all.
Or to engage in a discussion.
Yeah, so I mean, we've got interesting here. So basically we've got a confluence of contrarian, which is an oxymoronic statement, but still, we've got two different styles coming in, giving a slightly But then a lot of people are agreeing with you here in this room.
Well, I think it's interesting. I mean, it's a very small sample, so I don't think that it's a straw poll. But I think the idea is, from a technical point of view, is that if these levels, I mean, I'm not, if these levels break and the uptrend, the double levels begin to give way, then the implication then switches to very bearish. I know I'm slightly hedging the bet, but the point is, if those levels do break and there's a breakdown, then the downside target is huge on the dollar.
So make money, but then run away quick.
Well, it may well be this is a bounce that lasts 3 to 6 months, and then by the end of the year it loses momentum again. But at this stage, the dollar is oversold, and the selling pressure has expired. And whether it's a short covering, if you can have short covering, if it's a short covering rally, that sort of thing, maybe that's what it is. But these are very significant levels of support.
Yeah, I agree. Because if you look at U.S. policy, they are following a disastrous policy for their currency. However, I think that the dollar strength will not because of U.S. policy, but despite of U.S. policy. And I think it's more, it's caused more by factors happening outside the U.S., which causes dollar strength, than factors happening inside the U.S. And that's mainly because of the already mentioned shortage of dollars. I think we will experience another risk-off phase later this year, in the second half year, caused by tighter monetary policy, compression of margins, and also more worries about the high debt levels. And on that moment, we think the dollar shortage will hit its maximum. There will be a dollar squeeze, and that will be the fuel for a final dollar rally, finishing the rally we saw since in the past couple of years.
So this is interesting. I mean, I'm very confused now, because on the way here, I was reading about twin deficits, as I said, and I had a nice long time to be able to do that as I looked at the snow. And there was this feeling that a lot of the academic literature that came out originally was talking about twin deficit providing dollar strength, but then this time it was dollar weakness for quite specific reasons. And now I'm coming full circle listening to you. So maybe you can take me through that twin deficit analysis. I mean, you obviously alluded to it, and you've gone into it a little bit, but how you approach that scenario analysis?
Well, normally, if you have a twin deficit, you have to finance it. And in order to finance it, you have to offer attractive yields to foreign investors, or you have to offer an attractive currency, so that investors think, well, that currency is so cheap and so attractive, we want to invest in your country. Normally, and also from a fundamental and a theoretical point of view, if you have twin deficits, you either need to raise your rates or to depreciate your currency in order to attract enough foreign investments. Otherwise, no, and that's also the kind of correction mechanism. Because if you have higher rates, more capital will flow in, and if you have a cheaper currency, the depreciated currency also makes your export more attractive, and hence improves your foreign trade. So that's also a kind of correction mechanism, which requires that if you have a twin deficit, you either need to raise your rates or to depreciate your currency.
Absolutely. Do we have any dollar questions before we move on to some other topics? Yes, one at the back here.
Yeah, thanks. I just wanted to ask first of all, your model of that. I mean, when you foresee the dollar starting to pick up, I think you gave a fairly short time horizon for it to start that process. Could you just be a bit more explicit about the timing when you expect the dollar to start appreciating, and then telling us a little bit how far it might travel in percentage terms, how much of an increase you might think. And then, Tim, I had a question for you as well, which is when you're drawing your trend lines and you start to look at, say, for existence on the euro dollar as a proxy. I noticed that one is hitting the trend line almost a little bit around current levels, but the trend lines for some of the others weren't quite aligning. So does that mean that the euro could sort of break above that trend line and then get everybody excited and then it drops back down, or do you expect that one to be a proxy lead, decline immediately, and the others are not quite in the lines? So just those two questions.
Now, if we analyze currencies, stocks, bonds, and commodities, we use, besides fundamental analysis, also technical analysis and market signals, and also political analysis. But concerning your the time frame of our dollar outlook, we focus on the euro dollar. It's the main currency pair. And in the short term, there are technical signals which argue that further dollar weakness could be likely until if euro dollar is not dropping below 121.50, and the next support level is around 190. So as long as the euro dollar stays above 119, there's still a chance that euro dollar will go up in the coming weeks to 126, 128. However, on balance, if we look at the coming quarters, we foresee first a decline of the euro dollar to 112, and that's based on high interest rates in the US. Also, more relaxed view about the twin deficits and their negative influence on the dollar exchange rates. And we also think that in Europe there will be more tensions around the ECB policy. We now clearly see that Germany needs higher interest rates, and also the Netherlands and other economies which are already operating near full capacity. However, if you look at Italy, Portugal and Greece, they still need very low interest rates, and the ECB has to reconcile both interest, but that will become much harder if inflation is picking up. And I know inflation is disappointing at the moment, but beneath the surface, wages are picking up in Germany. If you look at input prices are picking up, so there are inflationary pressures building up. So the pressure from Germany and other stronger economies in the EMU will be bigger on the ECB to tighten monetary policy, or at least to have a less loose monetary policy, while the pressure from the weaker economies are still very strong to keep interest rates low and to have a more or less quantitative easing policy to keep also their long-term yields very low. So we expect also more tensions in Europe. And although I don't have any evidence of that, I suspect that a lot of growth we saw in the last couple of quarters has also to do with catch-up. During the euro crisis, a lot of companies and consumers suspended their investments or big outlays, and now they have confidence to do them at the moment or currently. However, that's a kind of that's a source of demand which is not sustainable. So I wouldn't be surprised if we now see the top of optimism for the European economy, and that could also contribute to a more euro weakness. So on balance, we see for the coming quarters a decline in euro dollar to 112, and if the tensions really flare up, or if there is a risk of leading to a short squeeze on the dollar, we expect euro dollar to parity. Yeah.
Peter, my response on the trend lines is, bear in mind these charts are long-term candlesticks. They're a month. Each candlestick is a month or maybe a week, but most of them are a month. When you get to trend lines, the downtrends, uptrends, or lateral levels, very often they are tested, as you know. That means nudging through. Somebody referred to a head fake this morning. That sort of thing can happen. And the way that you can deal with that is one of the sort of a mantra would be you look for the weekly close. So even if you nudge through the level during a week, you don't react. You wait to see where the weekly close is. And the Friday close in the US is very important. Well, certainly, I mean, obviously, currency markets are not quite so well defined in terms of market open and close, but the end of the week is a very good signal, and then the end of the month. And are we exactly at those lines? Funny sort of way, it doesn't really matter. We're heading towards downtrends on the euro, for example, against the dollar. So we're not far away. We've already reacted slightly. It may take a couple more months, who knows? But the point is there are headwinds for the euro against the dollar. And, the dollar is well supported against other currencies. So I would be reluctant to bet against the dollar at this stage.
So there are a few faces I can see in the audience that care about sterling. So first question, how do you add value in sterling analysis at the moment? Just read the papers, go on Twitter and then decide how you feel about sterling. Or is there, what are the real drivers and how does one approach that decision-making process?
Well, the real drivers, I think, for sterling are, as in the US, UK has a twin deficit. Although not as bad as in the US, but they still have one. The confidence in UK economy and UK assets has declined. So in other words, it also becomes a bit more difficult for the UK to finance its twin deficits. So that either means that interest rates has to go up or sterling has to go down. What you see on Twitter and in the news, big confusion about how Brexit will evolve. And I think the biggest problem is that the UK is divided. There's no clear view what their position on Brexit will be. Although there is a clear view, but that doesn't reconcile with the vision of the other European countries they have, because the other EU countries have, I think, a clear interest in making it as much as difficult for the UK to leave, in order to prevent that the Brexit will be successful, because that, all ends are loose. Catalonia will break up maybe, or other countries will follow the Brexit or the UK example. I think that it's a big priority of EU leaders to prevent that. So I think the Brexit negotiations will be very difficult and will continue to be very difficult. That will undermine, I think, the trust in pound sterling. Although we expect a bit of appreciation of the pound based on high interest rates by the Bank of England, and also quite decent economic growth supported by decent wage growth. We think that will be a short-term down move in the euro-pound exchange rate before it's heading up again, based on uncertainty about the Brexit. And we think if the Bank of England raises rates one time in August, we think, then I think they will finish their rate hiking cycle for a couple of quarters.
I think it's interesting that this is where the sort of noise element comes into it, that there's a huge amount of media pessimism about Brexit ever since the vote occurred, and the establishment appears to be very much against it. But the real decline in sterling came back in 2008 in the financial crisis. That's when you saw the percentage fall in cable, which was huge, compared to, then you had the Brexit fall in 2016, which took us down to, everybody was talking about parity. In fact, we got to 120 on or thereabouts on the dollar. And the mood has been very anti-sterling for 18 months, or maybe certainly a year. And in the last year, sterling has rallied consistently against the dollar, for instance. It's been a steady uptrend. despite the sort of constant stream of negativity. What we're getting to now, though, is sterling is getting to the top of the range. It's retraced most of what it lost to the Brexit sell-off, is now back to resistance. So I'm not saying that sterling is going up from here, but it's just interesting the way that the charts tell a different story from the headlines.
Right. So, so actually, those two kind of converge. I mean, in essence, you know, we've seen a rally, but the longevity of that is in doubt, and perhaps we'll see. If, you know, purely hypothetically, if someone was paying a lot of money for a conference venue in New York and they had the choice of spending all the money now or paying in June, they would pay it all right now, wouldn't they?
I think so.
So are there any sterling-based questions? Anyone? I think we can move on from that. And let's widen it out. We don't have much time left. So I think, if there are any other sort of general questions, yes?
EM currencies versus
Yeah.
the dollar.
Yeah, very good. I was going to do...
Well, the Asia dollar has been doing pretty well, and it's continued. In technical terms, it's got up. It's making progress up the range, but it's not definitive at the moment. We haven't reached resistance, and I think it's more about the renminbi having the dollar now having found some support against the renminbi. So that's quite interesting. The Asia dollar more widely, I think 30% of it is renminbi, has been a tremendous uptrend, but technically it's sort of betwixt and between at the moment, as far as I can see. I mean, you talk about we talk about there are some wacky moves in you know, the rupee or whatever it may be, or the Turkish lira, the peso, and I don't really have an opinion on them because they are so politically. Some of the more undeveloped countries are so politically driven. That I'm not sure that I've got much to add.
Yeah, the EM currency is a very broad group. So if you ask, well, what is your view about the EM currencies versus the dollar, automatically you have to look at the prospect for the US dollar, because that's the one where you can say something fundamental about. More broadly speaking, we are still quite positive about commodity prices for the coming months. So that means that EM currencies based in commodity exporters will profit from that. However, because we think that the dollar will appreciate, also based on a possible short squeeze later this year, as we expect a risk-off phase, that we think that will hit EM currencies hardest, because they have the biggest, or relatively speaking, the biggest dollar debt load. So their vulnerability for higher US rates and a stronger dollar is the biggest. So that makes them very vulnerable in I think the second half this year. But if you look at previous sessions, everyone was positive about EM assets, or not everyone, but the vast majority. EM assets are relatively attractively valued. Their growth prospects are superior to aging Western economies. So the inflow of capital will continue, we think, and they also profit from.
So if I'm getting involved in EM equity markets, am I taking currency risk or am I not?
I think a lot of people are taking currency risk,
okay,
because they are positive about EM and EM in general. Yeah.
Very good. Questions? Yep.
We've been staring at Bitcoin over your shoulder for quite some
Oh
time
yes.
during the session. So I
Do apologise.
I just wanted to ask, out of interest, out of the audience really, maybe a showing of hands
Yes.
who are interested in
Yeah. So if
Yeah,
you are,
that's funny.
If you are ignoring Bitcoin, put your hand up. Well, you're not actively researching. I'm about to ask you if you're actively researching, or are you active in. So those are the three bands: ignoring, looking at it, researching it seriously as something that, you know, could be an important part of things in the future, or are you active in? And just reading stuff on Twitter doesn't count as researching, by the way. So first one is ignoring. Second one is actively researching. That is active. Active isn't positive. So third one is active. Excellent, right? So we're all coming around to the party at your house at the end of the year. Yep.
I think you should have differentiated the terminology between Bitcoin and blockchain, because it is quite different.
Oh, yeah.
Oh yeah. No. Well, yeah. I wasn't. I thought I had done. But
I'm interested in blockchain, but I'm trying to know Bitcoin.
yes.
DLT, distributed ledger technology, which will decimate the financial services industry, apparently.
So yeah. So I mean, what's your approach as analysts? I mean, watchful eye. Clients asking you about it every meeting.
No, clients are not asking it. However, we are interested in the evolution of cryptocurrencies from personal interest, because you don't often see a bubble like the cryptocurrency. But also from a more fundamental point of view, we all know that since we have fiat currencies, the value of your currency is depreciating over time. And also the trust of people in their government and in their financial leaders is going down. So it's very interesting to see that the huge interest in Bitcoin or in other cryptocurrencies, it's for sure motivated by greed, but also I think for some people, and maybe a lot of people, about distrust in the currency, in their government, and also and that they are interested in or find it attractive to look at alternative ways to organize things. So I think it could be a source of threat or for the central banks. And yeah.
Last year, there were 175 funds, hedge funds mostly, set up to deal in cryptocurrencies. The capitalization is now 500 billion worldwide, roughly. Assets under management in these funds is about $3 to $5 billion. So I guess it's all quite small at the moment. And how many cryptos are there? Something like 1,500 of them, and there's an ICO every week, more or less. So this is an rapidly evolving space. But as you say, the technology behind it, the blockchain or the DLT technology behind it is incredibly important and interesting. The tokenization at the periphery of the blockchain technology is not going away. I think it's certainly the case. But how the institutions respond has been fascinating so far, because it's, you know, everybody from Jamie Dimon through has said all sorts of things about it, but it just ain't going away. So I just think that a lot more work to be done, a lot more research, because there's very little of that, and it's here to stay.
Very good. Well, on that cerebral note, I shall thank the panel for their time and their perspectives, and thank you for your attention. Thank you very much.